There's a dam holding back an ocean of money. For 25 years, this dam has redirected capital across the Pacific, flooding Western markets with liquidity that inflated everything from real estate to technology stocks to cryptocurrency. That dam just cracked. The Japanese 30-year government bond yield crossed 3.5% this week. The 10-year yield breached 2.13%. We haven't seen levels like this since 1999. While media outlets obsess over Federal Reserve meetings and political theater, the most consequential shift in global capital flows just occurred in silence. No press conference, no dramatic announcement, just a chart breaking a quarter-century trend line, and that break changes everything. Today we are going deep into why a bond market movement in Tokyo is about to drain liquidity from every major financial center on Earth. We'll examine the hidden mechanics that have propped up asset prices for 2 decades. And we'll explain why this particular moment represents the catalyst that sends silver into a repricing event that will shock even the most bullish forecasters. This isn't speculation. This is plumbing. And the pipes just burst. Let me walk you through the greatest financial arbitrage of the modern era. It's elegant in its simplicity, catastrophic in its unwinding. Imagine you're managing a multi-billion-dollar portfolio. Your job is simple: generate returns. But your own capital only gets you so far. You need leverage. You need borrowed money to amplify your bets. So where do you find the cheapest loan on planet Earth? Tokyo. For the past 2 decades, the Bank of Japan maintained interest rates at essentially zero. Sometimes they even went negative, meaning they effectively paid you to borrow money. This created what traders call the yen carry trade, a mechanism so profitable, so seemingly risk-free, that it became the engine oil of global markets. Here's the playbook. You borrow 1 billion yen at 0% interest. You convert those yen into dollars. You take those dollars and buy assets yielding 5%, 8%, sometimes 15% if you're chasing technology stocks or cryptocurrency. The difference between what you pay, zero, and what you earn, substantial, is pure profit. Multiply this across thousands of hedge funds, insurance companies, pension managers, and sovereign wealth funds. We're talking about trillions, not billions, trillions of dollars borrowed from Japan and deployed into Western assets. This is why retirement accounts went up every year. This is why real estate prices seem to defy gravity. This is why unprofitable tech companies traded at valuations that made no fundamental sense. The game worked beautifully as long as one condition remained true. Japanese interest rates had to stay near zero. That condition just expired. When the 30-year yield hits 3.5%, something fundamental shifts in the psychology of capital. Let me explain why this specific number matters. Japan is a nation of savers. They have some of the largest institutional pools of capital in the world: pension funds, insurance companies, endowments managing the retirement security of millions of people. For 20 years, these institutions faced an impossible situation. Domestic bonds paid nothing, so they were forced to take their money overseas. They became the largest foreign holders of US Treasury debt. They bought European bonds. They invested in Australian securities. They spread across the globe searching for yield, accepting currency risk and geopolitical uncertainty because they had no alternative. But now they have an alternative. And at 3.5%, Japanese bonds offer meaningful returns without currency conversion, without time zone complications, without the political risk of lending to foreign governments. For Japanese fund managers, this is the golden number they've been waiting years to see. And here's the critical part. These institutions have publicly stated in investor presentations, in annual reports, that if domestic yields reached 3%, they would begin repatriating capital. We're now at 3.5%. This isn't theory. This is documented policy. The Great Rotation has begun. Japanese investors are selling US Treasuries. They're selling European debt. They're liquidating foreign holdings and bringing that capital home. This creates a vacuum in Western bond markets, a vacuum measured in hundreds of billions of dollars. And when demand disappears, prices fall. When bond prices fall, yields rise. When yields rise, everything else in the financial system starts breaking. Let's get specific about scale. Japan holds approximately $1.2 trillion of U.S. government debt. That makes them one of our largest foreign creditors, second only to China, who has been steadily selling for years. The U.S. government is currently running deficits exceeding $2 trillion annually. We need to continually sell new bonds to fund operations. We depend on foreign buyers to purchase that debt. But what happens when your 2 largest creditors stop buying? What happens when they start selling? Elementary economics. Yields spike. When bond yields rise, borrowing costs rise across the entire economy. Mortgages become more expensive, auto loans tighten, corporate debt refinancing becomes prohibitively costly. The economy slows, then contracts. The Federal Reserve faces an impossible choice: allow yields to rise naturally and watch the economy implode, or intervene by purchasing bonds themselves. That second option has a name: monetizing the debt. It means the central bank prints new currency to buy government bonds that private investors no longer want. This is the trap. Japan's yield surge doesn't just affect Tokyo, it forces the Federal Reserve's hand thousands of miles away. A rate increase in one country becomes, through the connected nature of global debt markets, an effective rate increase everywhere. The dominoes are arranged. Japan just knocked over the first one. We don't need to speculate about what happens when Japan raises rates. We have recent evidence. August 5th, 2024, a date that should be burned into every investor's memory. The Bank of Japan announced a modest rate increase of just 0.25%, a quarter of 1%. The global markets seized up like an engine without oil. The Nikkei 225 crashed 12% in a single session, the worst drop since the 1987 Black Monday collapse. Cryptocurrency markets imploded. US tech stocks, particularly those most dependent on leverage and momentum, fell off a cliff. Why such violent reactions to such a small move? Because everyone was positioned the same way. Everyone had borrowed yen at zero to buy higher yielding assets. When the cost of that loan increased even slightly, the math broke. The trade became unprofitable. Algorithms triggered. Stop losses executed. The entire structure unwound simultaneously. Central banks around the world stepped in with coordinated interventions. They calmed the markets. They restored confidence. The crisis was papered over. But here's what changed. That was a 0.25% increase when the 30-year yield was substantially lower than today. Now we're at 3.5%, the highest level in a quarter century. The pressure building in the system is exponentially greater. If a quarter-point move caused a one-day crash, what does a breakout to multi-decade highs trigger? We're about to find out. Now let's connect this macro event to a specific opportunity: silver. When liquidity shocks hit the system, initial reactions are indiscriminate. Everything gets sold. Investors dump whatever they can to raise cash, to meet margin calls, to cover loans denominated in suddenly expensive yen. We saw this earlier this week. Precious metals dipped as traders liquidated positions. This is normal. This is the shakeout phase. But once the forced selling exhausts itself, a more profound realization sets in. If government bonds are no longer safe, if yields are spiking, if central banks are trapped into printing money to prevent systemic collapse, where does capital hide? Not in bonds. They're falling in value as yields rise. Not in cash. It's being actively debased to solve the debt problem. Not in stocks. They're leveraged to an economy that's contracting. There's only one category of assets that offers true independence from counterparty risk, from central bank policy, from the solvency of governments: hard assets. Gold and silver represent the ultimate form of unleveraged wealth. They carry no counterparty risk. They don't depend on someone else's promise to pay. They exist outside the system of debt that's currently fracturing. This is why, historically, when confidence in paper assets erodes, capital flows into precious metals. It's not sentiment, it's survival instinct. Silver specifically benefits from two simultaneous forces that gold doesn't experience to the same degree. First, the monetary demand. As the Federal Reserve is forced to monetize debt, printing dollars to buy the bonds Japan is selling, the currency debases. Inflation accelerates, real yields stay negative even as nominal yields rise. This is the environment where precious metals historically explode higher. We saw it in the 1970s. We're seeing the setup repeat now. Second, the industrial demand. Here's where it gets interesting. Japan is a manufacturing superpower: automotive, electronics, solar technology. These industries are voracious consumers of silver. As the yen strengthens due to capital repatriation, Japanese companies gain purchasing power in global commodity markets. A stronger yen means they can buy more raw materials with the same yen-denominated budget. So we have Japanese industry, flush with stronger currency, competing for a silver market that's already structurally tight due to underinvestment in mining, surge in solar demand, and strategic stockpiling by nations preparing for technological competition. Monetary panic meets industrial urgency. Both forces push in the same direction: higher silver prices. Let me take you deeper into the banking sector, because that's where this story gets truly dangerous. The global derivatives market, the web of bets and hedges that connects every major financial institution, has a notional value estimated between $600 trillion and $1 quadrillion. Now, notional value is an accounting term that inflates the scary factor. But even the actual money at risk is measured in the tens of trillions. Most of these derivatives are interest rate swaps. Banks bet on rate stability. They use massive leverage to profit from tiny movements. These bets were constructed in an environment where Japanese rates were zero, European rates were zero or negative, and global central banks were all easing in coordination. That environment just vanished. When Japanese yields spike, it cascades through global rate markets. Floating rate obligations suddenly cost more. Fixed rate assets suddenly yield less in comparison. The arbitrage that generated billions in profit for banks reverses. We're already seeing stress signals. Norinchukin Bank in Japan recently reported billions in losses from selling foreign bond holdings. US regional banks are sitting on hundreds of billions in unrealized losses from previous rate increases. The concern isn't just direct losses, it's contagion. In a highly interconnected system, one institution's crisis becomes everyone's crisis. Credit tightens, lending freezes, liquidity evaporates. And when that happens, central banks have only one playbook: inject liquidity, cut rates, restart quantitative easing, whatever it takes to prevent systemic collapse. This is bullish for silver, not because we want financial instability, but because the policy response to instability is always currency debasement, and silver is the escape hatch from that debasement. Here's something critical that every silver investor needs to understand right now. The difference between paper exposure and physical ownership has never mattered more. If you own silver through an ETF, through a pool account, through futures contracts, or through any financial instrument, you have counterparty risk. You're dependent on the solvency of the institution holding that contract. If that institution faces losses from the yen carry trade unwinding, if they face derivative exposure to Japanese rate moves, if they encounter liquidity stress, your silver position could be at risk. In a bankruptcy scenario, you become an unsecured creditor fighting for scraps. Physical silver, coins in a vault, bars in your possession, has zero counterparty risk. The metal doesn't care if a bank fails. It doesn't care what Japanese bond yields are doing. It simply exists, holding value independently of any institution's balance sheet. During periods of banking stress, premiums on physical metals spike because people wake up to this reality. The smart money exits the paper game and takes delivery. We're seeing those premiums expand now. The market is sending a signal. Get out of paper, get into physical. Let's ground this in data. How has silver performed during previous liquidity crises followed by central bank intervention? 2008 financial crisis. Silver initially crashed from $20 to $9 as forced selling dominated. Then, the Federal Reserve announced quantitative easing 1. Over the next 3 years, silver rallied from $9 to nearly $50, a 455% gain. 2020 pandemic, markets collapsed. Silver fell to $12. The Fed printed $3 trillion. Within 5 months, silver doubled to $30. The pattern is consistent: crisis, forced selling, policy response, explosive rally. We're currently in the crisis and forced selling phase. The policy response is inevitable. The Fed cannot allow the Treasury market to fail. When foreign demand disappears, the Fed becomes the buyer of last resort. That means printing. That means currency debasement. That means silver reprices. But here's the key difference this time. We're not starting from $12 or $9. We're starting from the mid-70s. A doubling from current levels takes us to $150. A repeat of 2008's percentage move takes us above $200. The asymmetric opportunity is staring us in the face. There's a term you need to know because you're going to hear it constantly over the next 12 to 18 months. Yield curve control, or YCC. Japan implemented this policy for years. They capped bond yields at a certain level, printing money to buy any bonds that threatened to push yields higher. The United States is about to adopt the same strategy, not because they want to, but because mathematics leaves no alternative. As Japanese investors sell US Treasuries, yields rise. As yields rise, the interest expense on our national debt becomes unsustainable. At current debt levels, a 7% yield would consume the entire federal budget in interest payments alone. The government cannot allow that, so the Federal Reserve will have to cap yields. They'll announce, formally or through their actions, that the 10-year Treasury will not exceed, say, 4.5%. To enforce that cap, they'll buy every bond that hits the market. Supply doesn't matter. Demand doesn't matter. The Fed becomes the buyer of infinite size. This is the death of the dollar as a store of value. It announces to the world the supply of dollars is now unlimited, yields are capped, and inflation is the chosen path forward. When investors realize this, when they understand that holding bonds guarantees negative real returns, capital will flood out of fixed income and into hard assets. Silver isn't just going higher, it's going to disconnect from historical norms because it will stop trading on supply-demand fundamentals and start trading as a monetary lifeboat. Let's talk specific numbers, because that's what matters for portfolio positioning. Gold is currently trading near $4,500. In a monetary crisis, which is exactly what yield curve control represents, the gold to silver ratio compresses. It moves back toward historical averages as silver outperforms. The modern historical average is roughly 40 to 1. If we divide 4,500 by 40, we get silver at $112. That's the conservative target, assuming gold stays flat. But gold won't stay flat in a crisis. If we see bank stress, if we see yield curve control implemented, gold likely pushes toward $5,000 or higher. At a 40 to 1 ratio with $5,000 gold, silver reaches $125. If the crisis intensifies, if we see genuine monetary panic, the ratio can compress to 30 to 1 or even 20 to 1. At 30 to 1 with $5,000 gold, silver hits $166. At 20 to 1, we're looking at $250. And if we get a 1980-style blow-off top, the kind of mania where people are lining up outside coin shops, the ratio has historically compressed to 15 to 1. That would put silver at $333. So our roadmap, conservative target, $112 to $125. Moderate crisis, $150 to $175. Severe crisis or mania, $250 to $350. We're currently in the mid-70s. This represents a potential 1.5 times to 4.5 times return from current levels. The risk-reward is asymmetric. Downside is limited by industrial floor demand. Upside is explosive due to monetary crisis. I need to be direct about what's coming. The path from here to $150 plus is not a smooth escalator ride. It's a violent, gut-wrenching roller coaster designed to shake out weak hands. As the carry trade unwinds, there will be days where silver drops $5 or $8. Margin calls will force funds to sell their profitable positions to cover losses elsewhere. Algorithms will trigger stop losses. News headlines will declare the bull market dead. These are shakeouts. They're orchestrated, sometimes consciously, sometimes just through market mechanics, to scare retail investors into selling. The commercial banks that are short silver want you to panic. They need physical metal to cover obligations. When price crashes, they're hoping you'll dump your coins so they can buy at distressed levels. If you're unleveraged, if you own physical metal with no borrowed money, you can ride through these swings. The only investors who get destroyed are those using margin, those playing with leverage, those trading paper contracts. Own the real metal. Hold through volatility. The macro wave is building, and those who stay positioned will catch the full force of the move. Let me tie the threads together because this is where the thesis becomes overwhelming. We have three major forces converging simultaneously: micro-level physical shortages, mining underinvestment, solar demand surge, strategic stockpiling by China and other nations. The physical market is tighter than at any point in modern history. Geopolitical, supply chain vulnerabilities, China's export restrictions on critical metals, rising demand from electronics and defense industries. Nations are recognizing silver as strategic, not just monetary. Macro, Japan's yield surge, carry trade unwinding, treasury market stress, Federal Reserve trapped into yield curve control, currency debasement accelerating. Individually, any one of these would be significant. Together, they create a perfect storm. The paper manipulation that suppressed silver prices for years is running into an immovable object, physical scarcity combined with monetary panic. When paper contracts face delivery demands they cannot meet, the price discovery mechanism breaks. We've seen this before in other commodity markets. It's about to happen in silver. So what is the Japanese 30-year yield hitting 3.5% really telling us? It's telling us that the era of free money is over. The global ATM, the Bank of Japan, has closed. The trillions of dollars that flowed out of Tokyo to inflate Western asset prices are now flowing home. This forces the US Treasury market into crisis. It forces the Federal Reserve to choose between two terrible options: allow yields to spike and watch the economy collapse, or print money to cap yields and watch the currency collapse. They will choose the second option. They always do. Protecting the bond market takes precedence over protecting purchasing power. For silver investors, this is the macro catalyst we've been waiting for. Not hoping for, because financial instability hurts real people, but recognizing as the logical consequence of decades of monetary distortion. The three pillars supporting this bull market are now in place: physical supply deficit at the micro level, geopolitical supply chain disruption at the medium level, central bank money printing to solve debt crisis at the macro level. Nothing remains to suppress prices except paper market manipulation. And paper burns when interest rates rise, when leverage unwinds, when counterparties fail. You've positioned correctly by understanding the debt dynamics before mainstream media catches on. You recognize that asset prices can't stay inflated when the funding mechanism breaks. Now comes the hardest part: waiting, holding through volatility, ignoring the noise, trusting the mathematics. The yen is moving, the bonds are breaking, the Fed is trapped. The repricing event has begun, the dam cracked, the water is moving, silver is in the path of the flood. Hold your position. The best is yet to come. If this analysis helped you understand the connection between Japanese bond yields and silver prices, make sure you subscribe to the channel. We're tracking every development in this unprecedented financial shift, and you don't want to miss what's coming next. The macro wave is building. Stay informed, stay positioned. I'll see you in the next one.